So, good day, everyone. Today we are going to discuss the BEPS influence on the personal income taxation globally. And here we have our best professionals from many countries of Europe who will share their insights, their interesting ideas on the topic. So we'll be discussing the major trends and changes that have happened recently. And here with me, I have my co-moderator. My name is Konstantin Asabin. I'm the head of tax of Alpha Capital in Russia. And with me, my co-moderator, please welcome Alexander Guskov. Also, we have Dmitry Zapal, who is the partner with the IFS Consultants. Dmitry, hello.
Hello. Good to meet you.
We have Walter Andrioni, who is the equity partner with Belluso Mercanti. Walter, buongiorno.
Good morning, everyone. Buongiorno a tutti.
Excellent. We also have Roy Saunders, the founder and co-chairman of International Business Structuring Association. Walter, hi. Walter?
Yes?
No, that was
yes. I'm very sorry. I'm very sorry. Roy Saunders. Roy, hi.
Hello, hi. How are you?
I'm very sorry. Yeah, Roy Saunders. We have Jose Aguilar Cia, the Square Patent Box partner. Jose, buenos dias.
Good morning, everybody.
And we have Alishaga Kanani, the tax partner to Bonner Lawson. Ali, hi.
Hi, everyone.
Okay. Now, with everyone introduced, let's start our panel. And I would like to begin with one of the most interesting aspects. The first question and the first issue is are the tax hikes on high net worth individuals, which may or may not resolve the budget issues, not only in Russia, but globally in Europe and different countries. So I'd like to ask you, what are the major trends in your countries? What are the government initiatives? And what are the main changes and trends with the high net worth individuals taxation? May I start with Roy, please? Roy, what would you say on the recent trends and actions towards high net worth individuals and the personal income taxation?
Well, hello, everybody. I think that tax hikes are both counterproductive and, of course, they're politically unacceptable as well. Just as an aside, when I first started practicing, which was quite a few years ago, as you can see, in the UK, we had income tax rates of 83%. And on investment income, we had an additional 15% tax. So people had to pay 98% of their income away to the government. And quite obviously, people left the UK. It was called the brain drain. And most of the people went over to the United States. So certainly tax hikes at the levels of taxation nowadays, they would be counterproductive probably. And as I say, politically unacceptable. But what the governments are trying to do now is to crack down on people pretending to be non-resident, if you like, those trying to avoid tax residence. And those issues are quite prevalent. And let me just explain how that is done. Tax residence used to be more of a mechanical presence test, really. The US was very complicated. It's still complicated. If you're there for more than 31 days in a year, you have to add to those numbers of days in the year 1/3 of the days in the preceding year and 1/6 of the days in the pre-preceding year. And if all of that total that you work out cumulatively works out at more than 183 days, then you're resident in the UK. So that's a total mechanical presence test. The UK also had the 183-day test, but they introduced the concept of ordinary residence. And that's what I want to talk about a little bit now. It's actually been replaced, that ordinary residence, by the statutory residence test, which I'll discuss in a minute. France has gone on to that as well. And in fact, this trend of finding out where the centre of vital interest is, they have 3 rules, and these are the interesting aspects here. First of all, the rule is if their home or foyer or principal abode is located in France, and they should spend more than 183 days in France, but even less than 183 days, if they've got their principal home there, they could become tax residents. or if they carry out a professional activity, or if their center of economic interest is in France. So this introduced the concept of social or economic center of vital interests, sometimes a nebulous idea, but the UK has quite refined that in the statutory residence test that we have. So we have three tests, basically. You're automatically non-resident of the UK if you're less than 16 days in the UK, or if you're in full-time employment abroad. You're automatically resident in the UK if you spend more than 183 days in the UK, or you're in full-time employment, or you have your home here. So it's similar to France. And you spend more than 30 days here, and you don't spend more than 30 days somewhere else. And then you have the third test, which is your sufficient ties test, which is 5 ties: where your home is, where your family is, where your work is, whether you were previously UK tax resident, and if you're more days in the UK than in a foreign country. And those ties will determine whether you spend their rules less than 46 days, less than 90 days, less than 120 days, and then less than 183 days. So they're varying rules here. Generally speaking, most of our clients can come in for up to 90 days in a year without really creating a big problem. But anything more than 90 days in a year is likely to cause problems sufficiently if you have the sufficient ties test. So that's a little bit of a rundown of this centre of vital interest. And this centre of vital interest is a feature in double tax treaties. We have what's called a tiebreaker clause in Article 4 of the typical OECD treaty, which says if you're resident in 2 countries, because both countries think that you're resident in those countries, you look at a tiebreaker situation. First of all, do you have a permanent home in one of them and not the other? But if you have a permanent home in both or neither, then you go to this second concept, which is the centre of vital interests. And generally, court cases have said that your social interests are a little bit more important than your economic ones. But whether the double tax treaty is appropriate is another issue. We now have the BEPS situation, which I'm sure everybody is aware of, and the multilateral instrument that came out of BEPS. And the multilateral instrument, Article 6, basically says that the purpose of a double tax treaty is to intend to eliminate double taxation, and it's not to create opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangements and anything where the objective of the treaty wasn't adhered to. So that's quite an interesting concept, whether or not double tax treaty can be relevant for your particular situation. So tax authorities are now looking very carefully at whether or not you really are non-resident of a country. And it's not so easy to lose your residence. In the US, for example, if an individual is resident in the US for 3 consecutive years and is then again non-resident, but then comes back within a 3-year period, then the guy's going to be, or the girl is going to be subject to tax throughout the entire intervening period. And in the UK as well, we have to remain non-resident for at least 5 years plus 1 day in order to completely avoid taxation of income and gains derived during that 5-year period when you were non-resident. And you're treated as if really you made that income and those gains in the year that you returned to the UK. So this idea of temporary non-residence is very important. The idea of being able to move from one country to another is what the tax authorities are trying to prevent. And of course, tax authorities now have the means to tax you on your pregnant gains when you leave a country through the exit tax mechanism. The UK doesn't have that exit tax, but for example, the US does. This is why a lot of US people are expatriating where possible. There are conditions, though. If you have more than a $2 million wealth, or if you earn more than 170,000, I think it is, a year, then you may have to pay this exit tax. And that is really taxing whatever you are worth at the time over and above what you pay for the assets at tax rates. So that's the basic idea is really they're trying to stop people just from flitting from one country to another in order to be able to avoid taxation. And this is one of the key features, I think, in tax authorities' armory at the moment.
Okay, thank you very much for your comments. So now we know that the main trend in the UK is not to make a tax hikes which are politically inconvenient. They just enlarge the tax base by making more people actually to pay taxes. As far as I know, there are special tax regimes in this context which are becoming more popular in many European jurisdictions like Spain or Italy or Switzerland. So let's start with Spain. Jose, the floor goes to you. What would you say? What are the trends? And does the special tax regime become more popular or less popular? And what would you say concerning those people who choose Spain especially on purpose of using this special tax regime and using the benefits of this regime?
Thank you, Konstantin. Well, let's start with the bad news, as we all kind of, like Roy anticipated, the hikes, unlike the UK and Spain, is concerned with the budget, of course, and the focus especially put on the individuals. I mean, we've had a pretty stable corporate income tax rate. When I know it seems like in the UK, they're inclining to the increase in taxes more on the corporate side and then the individual side. But in turn, in Spain, it seems like they've had some political pressure that the standard or top rates are still, there's still flexibility to increase those. So we've, until last year, our higher tax rates are generally around 45%. It varies from regions, and the top it was up to 48% in the Barcelona area, and Madrid is 43.5%. And that is where in the last annual budget, automatically for this year, so already applicable for this year, we've had increase in taxes at 2 percentage points. So now the top rate goes up to 50% in some of the regions and even up to 45.5% in Madrid, which is the lowest in Spain. So as you can imagine, high taxes, 50% flat, over 300,000. So every $2 euros that you make, you have to give half to the tax authority. So, and as you can understand, this is outrageous, and we have some talks of even wealth tax. So, I mean, going back to the good news, which was everyone wants to hear, obviously, is that there is tax planning opportunities for net worth, for high net worth, or even employees who are coming to, envisaging coming to Spain. And we've had this successful special tax regime, which is, let's say, commonly known as the Beckham Law, right? Because by curiosity, it was approved right when David Beckham came from Manchester to Real Madrid in 2002, 2003. And even though the government says that it has nothing to do, obviously, this is what the name kept through these last 20 years. And it's informally known as the Beckham Law, and more properly, the expatriate special tax regime, which it has some, I mean, it has a really strong benefit, which is that Spain would only, you would become fully tax resident, and you would only be taxed at a flat rate of 24% on your employment tax. And nothing would have to be declared on foreign taxes. Nothing would have to be disclosed on foreign assets, no wealth tax, no inheritance tax. That's pretty straightforward, and it's really positive to attract the move to spend the tax resident in Spain for foreigners. However, unlike other special regimes, which are, let's say, unrelated to any employment ties, like happens in Italy or UK or even Portugal, Spain requires that the purpose of the change of residency to Spain is linked to an employment contract or an appointment of directorship in a Spanish company. So, because this was initially approved in order to attract talent or attract qualified employees to Spain, right? So the standard application of this system would be, for example, if an international company would appoint a regional manager, a director in Spain, and that's the standard purpose of this. But at the end of the day, we've had strong attraction to high net worth individuals, because there's obviously a lot of ways around finding an employment contract. There is some exclusions that do not apply, as, for example, that it's not that straightforward that you cannot set up your own company and hire yourself from that same company. It has to be unrelated. You can't own more than 25%. There's some exceptions because family related person owning that. But basically, if you find an employment contract in Spain, you would just pay that 24% flat tax, and that's it. You're set forever. There's no minimum level of employment income. Obviously, we always try to, as again, since the purpose of the law was to attract an employment contract, we always say that you should have the higher the better, right? So that's why on the safe side, on top of 80,000, we always think 50,000 at least. That's something that we always encourage, to have a proper employment contract that justifies moving to Spain. No? And so the benefits of this special regime is only apply for up to 6 tax years, which that's the main point that we have to consider, that this is not a forever event or 10 years or 15 years like applies in other. We have 6 years, and then you become fully tax resident, okay? So the main benefit of this is that you are able to obtain a tax resident certificate. So in order to be able to prove your tax resident in Spain to a bank, to a foreign tax authority, you are able to provide your tax resident certificate. Tax return is pretty straightforward since you only declare your local income, and that's it. So you don't have to disclose any foreign income obtained by anyhow. So the only downside in this that I have discussed previously with the Constantine and the team is that you're not, that tax resident under the special regime is not entitled to treaty benefits, right? So we do have 2 separate tax certificates, tax resident certificates in Spain, which are that you're resident for tax purpose, for treaty purposes, and you're tax resident for domestic tax purposes. So in the event under an individual under this special tax regime, you would only be entitled to obtain that resident certificate for domestic purposes. So, for example, if you have investments in the U.S., I mean, there's no taxation on capital gains, but if you're subject to the 30% withholding tax on dividends. So that's a downside to consider. And unlike if you would benefit from the tax treaty, it could even go down to 0% or 10% in case of individuals. But it's something to consider, that where are the assets allocated, what's the estimated income, not only to consider the tax in Spain, but also to consider the tax at the source country. So this is really important. And finally, just, I mean, going in line with what Roy anticipated for the UK, our residency rules to let's say to meet the tax resident rules are pretty simple, and we don't have those more sophisticated rules in the UK or the US where they go back some years, 30 years. I mean, we have a straightforward 183 days rule. If you spend more than 183 days, you're considered tax resident. Then we have a second consideration, which is the economic ties, which basically is if you have main source of income or main source of wealth in Spain, you would be you could be potentially attracted as tax residency. And then there's a third presumption that you're tax resident in Spain if your legally married spouse and minors are actually resident in Spain. Again, unless proven to the contrary. So that the residency rules are straightforward. And just to bring a practical insight, that the concern of the tax authorities in Spain to determine the tax residence is more when you leave Spain, for example, a Spanish tax resident moving abroad, to attract the tax residency. But there won't be any scrutiny on saying that you've actually only spent 90 days in Spain, and so you're not able to, you can't claim the tax residency. In fact, they do not look at that. You claim your tax residency. They're always welcome to accepting new tax residency, so you wouldn't have a concern of how many days you actually spend in Spain, right? So that the issue would be more on the country where you actually spend most of the time, and that was the case. So this is basically, I don't want to extend further, but I think this is a good wrap up of our insights from Spain and on the high taxes for individuals and the ideal, the special tax regime that could attract anyone interested in moving to Spain.
Yes, excellent. Thank you very much, Jose. Now we just really know that there is everything straightforward and simple, but you're not liable to benefits with tax treaties, which can be, of course, a problem. And as far as I know, it's not pretty much not like this in Italy. So let's switch to Walter. Walter, could you please also comment on your special tax regime, which, as far as I know, also becomes even more popular because of all this, global trends and hunting for high net worth individuals and their tax income.
Yes,
So what do you
Constantine.
say?
Yes, Constantine, you're right. I would like anyway to expand a little bit my speech, not only on this regime, because all this kind of regime, as also Jose underlined, they come for a reason, and the reason is for the high net worth individuals. You don't want to make revenues on them. You don't want, even if you tax them very low, it's not the purpose of this regime. The purpose is just to let them in because they activate the economy. These people have a large possibility to make expenditure, so they will spend money, they will buy assets, they will employ people, and that's the purpose of this regime. So we need to weight the two measures. From one side, the COVID created a huge amount of costs at the level of the governments, every government, I would say. On the other side, there should be, let's say, the need to increase taxation, but to which extent? That's the point. Or is this the measure to increase the taxation for everyone, not only on the high net worth individuals? A good measure to recover the government expenditure during COVID and keep the economy growing. This, I think, it's really the question. And all this happens into tax systems which are pretty old. Italy is one of them. Probably the last reform we had, substantial reform of taxation for individuals. It's like happened 40 years ago. And then over time, the legislators are not touching the tax system as a system. They don't consider it as a system, but they go and change slightly kind of measures which normally are for pure political purpose. And this, over years, creates a disaster. So here we are, I guess, in Italy. That's the point. And then probably when you touch the bottom, it's the moment where good idea comes. I just would like to make you an example. Our tax system is a system with a progression, so it should be progressive taxation in Italy. First bracket is at 15,000 euro with a taxation of 23%. Then the last bracket, the highest one, starts at 75,000 and is taxed at 43%. So you can understand how the progression is limited into a very short range of different income. How a system can be progressive like this, I don't know. I don't have an answer. Probably 40 years ago it was fine. Now it's not anymore. So first measure, and the government now is thinking of it, and I hope they will do that, is increase progression, increase the number of brackets, and dilute better the increase of the tax rates. This is, makes the pair with equality, which for a tax system is absolutely important. At the moment, we don't have progression, which means we do not have equality.
You just have 43% tax, and that's all.
Right. Well, not for everyone, but again, it's a statistical thing. If you would see the statistical data on how the income is distributed, you will see that the majority of income is between 20,000 and 45,000. And there, all the weight of the system goes on this. because the tax rate is quite high anyway. Of course, 43 is high for when you get 75,000. But anyway, the marginal utility of €1 when you have 75,000 every year, it's much lower than when you have 30,000. So this is also an economic way of thinking that should be applied to tax legislation. And I'm sure that the economists that do this, they know perfectly. The point is, it's not good to touch tax legislation. You have to pay the price at the moment of vote. That's the point. But going back to technical things, the COVID showed fully the fragility of the system. I don't think Italy will increase taxation on individuals in general, because it's not the measure which we may afford. If they increase more, the economy will simply go down even more. And if you don't have a growing economy, your revenues will never grow. They will probably grow instantly next year, but then it will simply go down. So it's not the right measure. Together with this comes this kind of optional regime for foreigners which would like to become new Italian resident, and they have certain amount of income which justify the price. And now I can explain you just a bit better how this works. Even in this moment of constraint, I don't believe this new legislation on new resident will change. People are afraid that Italy would stop allowing this flat tax regime for high net worth individuals. I don't think so, because of the reason I said at the beginning. This is not a measure to collect more taxes, it's a measure to create a growth in the economy and then indirectly collect more taxes after. So it's a totally different story. How it works. A new Italian resident, which is defined as a person that in the last 10 years was not considered Italian tax resident for at least 9 years. So let's say there is a test you need to pass before opting for this regime. So you need to be a new resident. And in few words, this person will be fully exempt from Italian taxation on all his foreign income. And in exchange of this, he will pay a flat tax of 100,000 euro every year for 15 years, because that's the length of the option. Of course, you can stop before, but you cannot go over 15 years. So it's temporary. As Jose was pointing out, all this system needs to be temporary. They cannot be forever. Even the UK res non dom regime has a certain length. So what happens from a tax policy point of view, Italy on this regime, by applying this regime, renounces to the application of the worldwide taxation principle and becomes a pure territorial system for this kind of people. Of course, if the new resident produces domestic income, then this domestic income is taxed ordinarily as any other Italian. And this is the reason why, together with the length of the system which is defined, allowed this optional regime to be considered compliant with the EU legislation and with the kind of harmful tax competition prescription. It's something limited, and when you produce domestic income, you are taxed exactly at the same rate of the others. The only exception is on your foreign income. That's absolutely important.
Okay.
What is important as well is the regime allows the taxpayers to apply the tax treaty network of Italy. So differently from the Spanish regime, in this case, Italy allows to apply the treaty. And together with this, there are some goodies, as we used to say, you know, there is no gift taxation for a new resident. There is no inheritance taxation. There is no obligation to disclose your foreign investments. Plus, there is also an exemption from two main extraterritorial taxation, which are applied to the foreign real estate and foreign investment you have. So let's say there was a lot of debate on this regime, on the fact that it was constitutionally correct, that was compliant with the EU law, but you know the system passed all these juridical tests, and it happened to be a very nice regime. And in COVID situation, we saw an increase of people willing to adopt this optional regime in Italy.
Yeah, thank you for comments. So let's move further and let's discuss the tax residency planning, which was really changed and even challenged by the epidemiological limitations. So, due to the fact that we have recently faced the even damage for global mobility, are there any interesting practical cases that you have recently faced in tax residency planning, or have your governments introduced any initiatives for those trapped due to COVID? Ali, what do you think?
Thank you, Alexander. Perhaps I can also add some comments from a Swiss point of view on the tax regimes that we have in Switzerland, and to reply to the questions that Constantine was asking about increasing taxation for individuals in Switzerland. I would say it's already quite high, the tax rate in Switzerland. We can have a progressive rate that reaches 45% for individuals. So the trend in Switzerland would be rather to reduce the corporate tax rate in order to give some incentives to entrepreneurs to come to Switzerland with their business. And that's the most important trend since last year in Switzerland. If we look at high net worth individuals who are willing to move to Switzerland, of course, they can benefit from the lump sum tax system in Switzerland. And I'm not going into the details, but in order to give you an overview of how this specific tax system works in Switzerland, there are some conditions to be fulfilled for the individual. He has to move to Switzerland, of course, effectively, and take residency in Switzerland. So he has to spend at least 90 days in a row in Switzerland annually. And of course, a fictive domicile will not give him the right to benefit from the lump sum taxation. The downside is that he cannot carrying out any lucrative activity in Switzerland. But of course, any activity abroad could be acceptable for the tax authorities. So, and of course, he cannot be a Swiss national. That's also one of the debates that we had many years ago. Walter was talking about equality in taxation for people. Of course, there is no equality in that from that point of view. But of course, the lump sum taxation, if we look at it from a general point of view, it means that you don't have to declare your worldwide income and wealth to the Swiss tax authorities. But in order to simplify the determination of your tax base in Switzerland, the Swiss tax authorities allow you to declare your annual expenses to the tax authorities, on which you are, of course, taxed. And the minimum amount which is used as tax base under the lump sum tax regime in Switzerland is 400,000 Swiss francs. This is the taxable base. And of course, if you are from a non-European jurisdiction, then this minimum could be a bit higher based on the fact that your expenses will be also a bit higher. And the minimum is also 7 times your rental income that you are paying in Switzerland, or the deemed rental income of the property that you have bought in Switzerland. Of course, this gives you an overview of how the tax system works in Switzerland for high net worth individuals who are benefiting from the lump sum tax regime. Just a few additional comments. There is no gift tax or no inheritance tax in Switzerland, or in some cantons it's a very low tax rate. And the trend also, in order to, tax authorities always need more money and to collect more taxes. And of course, during this COVID period, in order to come back to Alexander, to your question, the tax authorities are also trying to collect more taxes by contesting the deduction that you may invoke from your taxable income. And there are more and more tax procedures also. And perhaps we will have the time to talk about this in detail when we will discussing the information exchange topic. So that's my comment from a Swiss point of view, Alexander.
Yeah, thank you for comments. Actually, Switzerland looks like very friendly place for high net worth individuals comparing to other parts of Europe. So, Dmitry, and what about your comments?
Okay, thank you, Alexander. Thank you very much, dear speakers. I'm actually glad that I'm speaking at the very end, because I thought I would give a practical overview of everything that you have been saying from the point of view of clients which I'm advising. Let's start with the UK. In the beginning, we were asked if there are any trends in hiking up taxation in the UK. The biggest fear was that they would introduce wealth tax in the UK, and also that they would bring up the capital gains tax, which is at the moment 20%, to income tax rate, which is 45%, essentially making double. The problem with the UK tax system is that the parliament can overnight instantaneously pass legislation which will make your tax situation very, very bad. And I had calls from clients literally asking me, we think there will be wealth tax, what shall I do? And I was telling them, well, it's all rumors, don't do anything, maybe it will not pass. But thankfully, the last budget showed that the tax hikes are not to be extended. However, those people who have lived in the UK for a significant period of time and who are now waiting to become domiciled in the UK, and if they become domiciled, they can no longer rely on the beneficial tax treatment of non-domicile taxation, where you don't pay tax on your foreign income. So all those people who are coming to the end of their stay are now thinking, where can they go? And this is also an interesting comment to what Roy was saying before about the attitude to residents, etc. And all of these people, they're very mobile, and they will go to great lengths to become not resident in the UK if the UK would increase tax rate. And of course, they would be shooting themselves in the leg if they were to abolish the non-domiciled taxation, or if they were to increase the tax rates. So now all those clients who do not want to pay tax on their worldwide income, what are their options? Thankfully, owing to the new rules under the statutory residence test, it is very easy to become not UK resident. Very easy meaning you know exactly how few days you can spend in the UK without becoming resident. However, of course, it doesn't mean that it's easy to become non-resident, because in some circumstances you can spend as few as 1.5 months 45 days in the UK and still become resident and still remain resident. But at least you have this certainty. And the UK, it does not ask you to be a resident somewhere else. As long as you're not a resident in the UK, as long as you spend fewer than 45 days or 90 days, you do not need to pay any taxes here. You don't have any residual tax liability. Now, what are the opportunities for them? First of all, we've seen an exodus of people from the UK to Spain. And thanks to Jose, we've seen a few very good clients taking up employment in Spain. The problem, of course, is that okay, let's put it straight. Not everyone has companies which want to take them on, and of course, sometimes they have to find ways of starting businesses, etc., so that and independent businesses, so that they can be appointed managers. But Spain has been tremendous for the UK people living. The best thing, of course, in Spain is that you are technically fully exempt on foreign taxes, on taxes on foreign income, even if you bring them in Spain. Of course, Italy has been a destination for some of our clients. The problem with Italy, unfortunately, is that paying 100,000 euro is quite a significant sum and doesn't always justify your tax liability and minimizing your taxes and still paying 100,000. Moreover, the problem with Italy is that, from what I recall, if you are selling non-portfolio shareholdings within the first 3 years of residence, you will have to pay tax. So in Spain, you can go to Spain and you can sell your companies and not pay tax in Spain. However, if you're a business owner and you're moving to Italy, then it may be a bit more difficult. From what I understand, also Italy has been very good for people who want to retire. And if you go to certain developing communities, such as Sicily and a few others, then you don't have to pay as many taxes. But many of our clients are still very active. And of course, Switzerland. I spent a lot of time speaking to Ali about tax planning in Switzerland. And well, lump sum taxation is not for everyone. Of course, to begin with, you have to pay still a lot of taxes on the agreed tax base, which I think is 400,000 Swiss francs or something around then. I know that it helps if you are an EU citizen and if you're moving to Switzerland, your lump sum tax is smaller. But finally enough, with Brexit, now that the UK is not part of the EU, those people moving from the UK to Switzerland probably now have to get another European citizenship, such as Maltese or Cyprus, in order to benefit from the lower tax rate. But I'm always advocating practicality before tax advice. Roy, on many occasions, Roy has told the story of a client who wanted to go to Jersey to avoid paying tax. And I think he always asks his clients, what does your wife think about it? And in this particular case, the client's wife, well, she was not consulted. And although he saved a lot of taxes, he wasted a lot of money on the divorce proceedings. So I've learned it from Roy, who's been my great teacher, to always ask the client, what do you really want to do? So coming back to Switzerland, in reality, if you move to a canton such as Obwalden or Zug, you don't really have to pay much tax. And you don't really have to run an offshore company from Switzerland, because you can always run a company from Switzerland, pay a reasonably low rate of tax and be well off. I think the benefit of Switzerland also is that they probably do not enforce management and control rules as hard as the UK. And Ali may correct me on this, but from what I know, I think it's kind of okay to run an offshore company from Switzerland and maybe not pay and maybe not make it tax resident in Switzerland, but it's still, well, it's possibly a planning point which Ali can comment on. But so at the moment, I've told you about the destinations where people are going from the UK to all the other countries. But I just wanted to share with you a few practical also experiences which I've witnessed recently. For example, I'm advising an entrepreneur who moved from the UK to Germany many years ago. And now this entrepreneur wants to leave Germany and he wants to go to another country. And the reason he's leaving Germany is because he does not want to pay tax on his significant assets. And I learned that if you are leaving Germany to a low tax country or for tax reasons, you still have this residual tax liability in Germany. And first, I considered him moving from Germany to Switzerland, but Germany has this treaty override, which means that even under double taxation treaty, even if you're exempt from tax in Germany, you must still pay taxes after you become non-resident. And this is a huge problem, not only in Germany, not only in the States, but for example, in Ireland. And when we were preparing for this discussion, Konstantin and Alexander asked me to consider the impact of BEPS on these residence provisions and how it affects high net worth individuals. And I thought that actually well before BEPS was introduced, some countries, the US, Ireland, Germany, and I'm sure other countries, have had this exit tax, which in essence prevents you from structuring your tax affairs, which go contrary to the local tax norms. And just as another interesting issue which we've been looking at, the question of UK domicile. Domicile is a concept which is pretty much non-existent from the tax point of view around the world. Just to give you a short summary, domicile signifies your very close connection with a particular country, in this case, the UK. And if a person not domiciled in the UK, they don't have worldwide tax liability and they don't need to worry about the inheritance tax. And just by way of the anecdote, this particular entrepreneur living in Germany, he is UK domiciled, but he wants to transfer certain of his assets to an offshore trust. And because he's UK domiciled, if he transfers these assets to a trust, he's facing a huge inheritance tax liability because this is how the UK law operates. Now, before he was hoping to give up his UK domicile of origin and acquire German domicile of choice, and by doing this, he would be outside the scope of the UK tax net and he would not suffer inheritance tax. But now, since he's leaving Germany and going to another country, he will have it very difficult to prove that his domicile has moved from the UK to Germany. And before he establishes his new place in a new country, it will stay his UK domicile of origin. I guess this point really illustrates how multifaceted the idea of international tax planning is. And I tend to specialize in direct taxes, income tax, capital gains tax, but how much inheritance tax plays a huge role in structuring your personal taxation. And just to come back to the main, I guess, theme of this discussion, what's to expect from BEPS? I think the principal purpose test and what Roy said before, the main purpose of the tax agreement, which is not just to avoid double taxation, but also to avoid double non-taxation. I think this will be a very significant instrument in the hands of international tax authorities, which want to curb such cross-border mobility and tax planning. Thank you.
An excellent comment. Thank you very much. My question is a quick, short one concerning the last year that we faced something really bad with the COVID issues. There were some individuals, just to complement the issue of tax residency planning. There were some major changes in Russia, for instance. We've introduced the 90 days concept of residence for those who were not able to return. So if they still wanted to pay taxes in Russia, they had the possibility. So just 90 days in 2020, and you can pay taxes in Russia. Were some something alike introduced in European countries, Walter, Jose, or they just they didn't pay any attention to the trapped individuals? What would you say, Jose, first, if you don't mind?
Yes, of course, Konstantin, thanks a lot. Well, I mean, we've had this concern because, as you know, there's been a lot of people trapped in their second residency somehow, right? Or they decided, I mean, we've seen, and I've also discussed this with Roy, right? That seems like that now there are more, the houses in the outside of the cities are more valuable than in their own city, right? Because of those online working and stuff. So the same thing happened in Spain. I've had some individuals that even that they were expats in Latin America that ended up being now in Spain, or they ended up deciding to go to Marbella to spend their lockdown somehow. So we've seen that there was a surprising tax ruling from the Spanish tax authorities in February this year, in 2020, February a year ago, right in the middle of the lockdown, where Lebanese family was saying that they were stuck in Spain and whether there was any flexibility in considering the tax residency. And the answer was pretty straightforward, saying, well, no, if you spend 183 days, you're taxed in Spain. So I think this was more, and I know the OECD raised an issue on this, and they kind of, some other, I know France did, and UK explaining that there is flexibility and the day count, but Spain hasn't. But recently, the tax authorities did issue some kind of regulation and notice, basically saying that no need to clarify this because under the OECD, there is some exceptions on the day count, which could be seemingly applicable under Spanish legislation. So, I mean, I do not anticipate the tax authorities to be really aggressive on this, other than in situations where, I mean, you can find that the tax individual kind of took advantage of that and they were stuck somehow. But so I feel, I mean, the advisors kind of feel less concerned about this issue than we were a year ago when this strange tax ruling came out. So there should be, as conclusion, some type of flexibility by the authorities to attract residency on this 2020 tax regime, especially.
Okay, Walter, any changes due to this difficult situation in Italy, or your government reacted the same, just don't care?
The reaction was similar. Of course, the problem was there. It was quite evident and serious at the beginning, because the question was really, I'm a foreigner, I'm trapped here in a quarantine situation, I cannot move. Will this day count? Because Italy gives the tax residents not only on this, but this is one of the test. It's the 183 days. So of course the case was there. Tax authorities at the beginning didn't say much. They was a bit reluctant to release a point of view on this. Then the OECD came out, and of course this was an absolute exceptional case, and these exceptional cases are the one which can create a difference in calculating the resident the days of residence. Exactly this was the outcome. Also, tax authorities recognized that this was an exceptional case, and that those days shouldn't be counted for the tax residents. I think this is not much of a juridical aspect. It's common sense, which sometimes, probably works even better. And so I don't expect the tax authorities to try to tackle these, or to find in some of these cases something, to attack you on the residents.
Really sounds rational. Maybe some other practical cases that we can discuss. Ali, do you have something interesting on that as well, about the migration aspects, the trapped individuals, maybe the new residency planning tendencies with the taxpayers in Switzerland, or the potential taxpayers in Switzerland? Could you comment on that as well?
Yes, thank you, Konstantin. Perhaps I can add one specific point. As you know, Switzerland is a very small country within Europe, and especially in Geneva, we are surrounded by French territory, and therefore, and naturally, we have a lot of cross-border workers. And since last year, when the Swiss federal government recommended the home working, the teleworking, therefore these cross-border workers were not coming to Geneva to work, but they were working from their home based in France. And therefore, we have an agreement between Switzerland and France that says that even during the COVID period, if a French cross-border worker has to stay at home and has to work from his French residence, then there is no difference. He will be still taxed in Geneva at source, and the social security contributions will be also paid in Switzerland. So, for instance, for neighboring countries, I know for Geneva, for Germany, for instance, we also have this type of agreements. But for countries, non-European countries, further countries, we may still face this type of issues. We saw recently for a non-European family, they were living in Switzerland under the lump sum regime. They received the residency permit that you need to obtain from the from the authorities here. And we can see also in Switzerland that there could be potentially a discrepancy between a contradiction between the permit authorities and the tax authorities. In this case, the permit authority said, well, you are not living anymore in Switzerland since March 2020, even if it's due to COVID, you are in your country of origin. So therefore, you are not allowed to have or to be entitled to have a residency permit in Switzerland. And we still haven't received the decision from the tax authorities, but the tax authorities may say that from a residency point of view, you still have the intention after the COVID situation is completed, is finalized, hopefully soon, you still have the intention to come back to Switzerland. And therefore, since March 2020, from a tax point of view, I still consider that you still have your residence in Switzerland and therefore fully taxable in Switzerland, according to the lump sum tax regime. And that could be, a new procedure that perhaps we'll fight in courts.
Okay, thank you. It's an interesting insight, an interesting case. So returning to BEPS impact, I would like to pass on to the... yes.
Can I just mention something, which is
okay, of course,
in relation to that? I mean, first of all, you know how flexible we Brits are, of course. So we've been fairly flexible about COVID. In fact, I mean, in some respects, if somebody is trapped in the UK, for example, because they've got a medical problem and they've had to stay in the UK, for many, many years, we've had this concept of ordinary residence, if you like. So we will not, the tax authorities will allow some flexibility in terms of people who have suddenly found themselves in the UK and because of medical or other reasons. And of course, COVID is a medical reason. But what I was going to say was that if somebody's trapped somewhere for, it reminds me of what Ali was just saying about the French employees being trapped in France, as opposed to being able to come into Geneva to work, that most countries will say that will not create a permanent establishment for the company because an individual who is perhaps even the managing director of that company has to stay at home because of COVID. So that's just another aspect I just thought I'd mention.
I just also wanted to add to what Roy's been saying about the UK response to the, if someone is staying in the UK for the exceptional circumstances. Now, the UK, under UK statutory residence rules, you can shave off up to 60 days from your day count if you are in the UK due to the exceptional circumstances. Now, the criteria are very strict in determining what are the exceptional circumstances. And in the best HMRC fashion, they said that on the one hand, if you are here because of COVID, these are exceptional circumstances. But however, you can only take off up to 60 days if you were physically prevented from leaving. And this puts many people in very bad situations, because in principle, you could have jumped on a car and driven out of the UK through the tunnel, etc. But you would have to stay here. And the problem that we as tax advisors are facing is that many people still don't know if they were UK resident or not during the COVID times. And to find out, they need to file a tax return. So the process is you count your days without the deduction. If you are a resident because of this, then you file a tax return as a resident. Then you ask the tax authorities to reduce your day count by the exceptional circumstances and ask them to consider you non-resident. And it's a real bad situation because we don't know how it will affect people. And I don't have the answer to this yet, and maybe in a couple of months' time, we will know what to say to people.
So first of all, you show that you're a resident, and then only after that you ask for some special permission.
That's
an interesting
right.
system, I would say.
And just to finish this off, as Roy said before, your current residence depends on the number of days you spent in the previous years. And with this, so for example, even if you were not UK resident in the year, but then you still, even if you were not resident, and even if you don't have to submit a tax return, you still have to submit a tax return to show that even that it doesn't affect you later, which just puts costs and strain on people. So watch the space, as they say.
Yeah, but it provides you with some business then if you want new clients and their requests, which can be viewed as a positive side of the issue. Any other comments on geographical migration? No comments. Okay, so let's pass on to our next question. Next issue that we are going to discuss, to return to BEPS. As you might have heard, there have been major changes, for instance, in Russia with the controlled foreign companies regulations, mainly introducing the so-called lump sum system or the fixed tax to be paid, which provides for some exemptions for the individuals, or mainly for high net worth individuals, of course, in Russia. What are the CFC regulations trends in your countries, and what structures are now mainly reviewed by the taxpayers or with the consultants? What is the focus of the tax administrations, if you don't mind, if you have noticed some trends? Let me also start with Roy here, if you don't mind, and mainly I will precisely ask you not only about UK, but for instance to comment on the US initiative that have recently been introduced.
Yeah, the trends following BEPS is that tax authorities are looking much more. We had two basic concepts of taxation for companies. One is where the company is resident for tax purposes, and the other is where the company receives income, the source of income. And this source of income has been extended so much recently as to where the source really is. So, for example, I mean, we started with the Vodafone case, which I'm sure everybody is very well aware of, where one non-Indian company sold Hutchison Telecom to another non-Indian company. And the authorities there in India said, but the source is really the Indian telephone system that Vodafone is buying. And therefore, there should be tax there. And then it goes on to something like Google, for example, where Google in America or wherever they're based in Ireland, but receives income from advertising from American sources. So, why would the French tax Google? And the French say, but the source of the income that Google receives, the advertising revenue, is derived from the fact that people in France are logging on to Google and are sharing their tastes and so on and their preferences on Google. And therefore, the advertisers know how to maximize their revenue. And this concept of digital services, if you like, is really the most, I think, the thing that tax authorities around the world are focusing on now. It's really where market value is created, and that's sort of replacing to some extent the traditional sources of where turnover might be or whatever. It's where market value is created, and that creates a whole new area of activity for digital services. In the US, for example, you have this GILTI, GILTI legislation now, which is really extensive. I mean, for CFC purposes, yes, it's still 50% ownership or more than 50% ownership. So if you have a direct 50-50 relationship between a US and a non-US person, that wouldn't necessarily create a CFC. But you have to look beyond that, because you have obviously you have the PFIC rules, which is the passive foreign investment company rules, where a foreign company has passive income, you could still tax that even if it's not a CFC. So even a 10% ownership, for example, of a foreign company can create a US tax liability. But now they've extended a lot the subpart F type legislation that they have towards active companies as well as passive companies as well, with this GILTI legislation. And time won't permit me to go into that too much. But I think the whole trend, if I can say that, the whole trend of the tax authorities is now looking at where market value is created. And that's a totally different concept in some respects than what we have been used to in the West. But, you know, for my association, the International Business Structuring Association, we have online meetings all the time. And one of the meetings that I held with a guy from KPMG in Hong Kong was on this concept of market share, market value rather. And he said, but the Asian authorities have done this for many, many years. They've looked at it, they've gone way beyond our recognition of source, if you like, to where market value is created. And this is a concept that in Asia is very prevalent. So I don't know what the other participants think about this, but certainly the way that we're going to be taxing digital services in the future is going to be dramatically different from how we've thought about it in the past.
Okay, maybe some new insights with the CFC rules in Spain. Could you comment on that, Jose, please?
Yes, of course. It was this was an interesting reflection from Roy, right? Because that's the digital services. I understand is not reaching any agreement in the level of the OECD because of the different thoughts. So I mean, but I like the approach on the digital tax just because it's something that, I mean, the uncertainty around CFC is that it's seen as an anti-abuse clause, right? So that's how we see it. So I fear that you have to analyze whether you fall within the anti-abuse rule or not, which creates not only uncertainty around the taxpayer, but on inspection. There's going to be different positions around the world. And the digital tax, even though it's surprising, it just changes the rule of taxation, right? The same question that Roy asked about why is Google taxed in Spain? I mean, in France, in Germany, it's the US company. There's no doubt on that. Well, then make the rule. I mean, other than claiming inassistant digital permanent establishment, that you've seen strange approaches from different tax jurisdictions, which the only approach was let's tax that income. So I'd rather have an objective, okay, there's a digital tax, there's tax like this. So it's clear and globally applied similarly if we can find the conclusion, at least within the European Union or eventually in the OECD, because otherwise you are falling into these aggressive transparency rules. And again, we have, as you know, the CFC rules in Spain, and we've explained, we've had those for 25 years, and I still know that a lot of Latin American countries do not have CFC rules for individuals, for example. So when I see those Latin America's fortunes coming to Spain, they come with these trusts, these Panamanian entities, these empty shells, and that doesn't work within the OECD standards now. So, and one of the interesting approach that the Spanish tax authorities had is that they included a new, before the CFC rules, as Roy mentioned, were focused on taxing passive income, right? So that's something, if you meet certain requirements of control and low taxation, that passive income is attributed to the residency country. Well, now in Spain in 2015, they added a provision where it said that you not only tax on that passive income, but provided, and I'm introducing this new concept that it's familiar with all the speakers, the substance requirements. So we already have now a CFC rules, which not only applies on passive income, but also there's an automatically CFC rule on any company, foreign entity that does not have substance. So we have those cases now where, for example, you decided to set up a Hong Kong company to do trading income, to have trading income, right? Trading income is active somehow, right? Because that does not fall within the standard CFC rules. But now we have that situation. Well, wait a second. If you do not have sufficient income, sufficient substance in that, you're automatically attributed. So again, it's seen as an anti-abuse rule that is triggering. It's, again, I say it's an anti-abuse because we don't see that a lot anymore, because it really prevents you from that tax planning to set up a Hong Kong company and try to do trading with China, like it was done 20 years ago, and you had very tax efficient. So now this is one more of the plenty anti-abuse prisons that we're seeing across Spain and Europe and under OECD BEPS languages. So that's more of the Spanish approach.
It's really a worrying trend, I would say, because there are lots of trading companies without any substance in Hong Kong. With those no employees, no offices, just trading activities, just trading income, which
And
is mostly active.
and that's interesting. So when I have clients come up on that, I say, international tax planning is still a thing. Don't forget. People think it was no, but if you want to do trading in Hong Kong, make trading in Hong Kong. Send 3 people there. Inditex, Thara does trading in Hong Kong. Well, it has 50 people there in Hong Kong trading, right? So you can do it, but we have to be worried of different things so we do not fall into those anti-abuse clauses. So there's still room for tax planning. That's my final conclusion, right?
It's a positive one, I would say. Yeah, but on the other side, as far as I know, there might be some issues with the residents in Hong Kong if you create major substance there. So
that's true.
It can end in taxation.
Can I have a minute for a comment?
Yeah, of course.
One comment to Jose. It's very right. Under CFC regulation, the abuse is the deferral. So the deferral is seen as an abuse. It's a temporary abuse because sooner or later the income will flow through. But what they want is to make it flow through immediately.
Well, unless you have the participation exemption.
Okay. Yes, that's a point, because then if you have participation exemption, then the discussion is, but is the CFC income flowing through, fully taxed, or it goes under the participation exemption? So that's always the point. And then another comment is about substance. Trading is always an issue, but for example, a holding company, what's the level of substance of a company which is managing participation in other countries? You don't need much. You don't need incredibly high amount of people and offices and structure and assets and costs. On this, there were kind of smart cases in Italy discussed and decided by the Supreme Court, which said the holding company doesn't need to have a great structure to be considered an operative company. So this was very good. It was a principle of law which put some order into this discipline. And it happened that this holding company, was just enough to have regular shareholder meetings, board of directors, but the key people are few. They don't have to be in a great number, and that's I always find it very important. My third comment on Roy discussions about the web tax, absolutely interesting. It's of yesterday, the news that the Italian tax authorities came up with a 90 pages circular letter on the web tax. And what I found interesting is the web tax it's not a direct tax, it's an indirect tax, so that it doesn't fall and it's not covered by the treaties. Frankly speaking, I didn't read thoroughly the 90 pages, which I will do in the next couple of weeks, probably. But it's interesting to know that the discussion on the web tax, it's not over, it's just the start.
Walter, if I may just comment on that, I think that the potential, and what Jose says, well, the potential for double taxation is enormous with the web tax, as you call it, the digital services tax. The other thing, comment I would make, you talk about substance. You're very practical to say that a holding company doesn't need substance. But for example, in the Netherlands, they've actually passed the legislation that to create substance, to be accepted as either a holding company or even a subsidiary company, you have to have 100,000 euro of employee payroll and an office in order to be able to do that. So in so many of the holding companies wouldn't be recognized, and therefore the double tax treaties between the Netherlands and those countries wouldn't be accepted by the tax administrations. So, I think you're much more practical in terms of holding companies than the Dutch are.
Well, the Dutch are always recognized for being practical, and at least, they give you a threshold.
Yes.
At least you know what to do, because in all other, or in many other systems, Italian one included, you never know where is the point where you need to assess the substance in order to feel safe. It's always a debate. There is always a discussion, and it's an endless discussion because there are no criteria to use.
Okay. Thank you very much for the comments. Any other ideas on the trends on the CFC rules or some major changes or initiatives that are being discussed or even introduced?
I thought I would just cover the issue of CFC rules for individuals in the UK. Now, there's not much to say about corporate CFC rules because, well, they're just the usual the bunch of anti-avoidance rules. When we're asked by Russian advisors about the extent of individual CFC rules, often tax advisors don't understand what they're talking about because these are not called CFC rules. They're called something absolutely different, but the effect is the same. If a person is a resident in the UK, then if they own a foreign entity or if they are in a relationship with another individual, and this entity person is earning income or capital gains, it can be attributed to the person living in the UK. So the effect is, in practice, the effect is the same as the control from companies rules, but it's called in a different way. I have seen quite a lot of the difficulties caused by these rules for people who are moving to the UK. The main difficulties revolve around the fact that the rules apply in all cases unless they are exempted. And in many cases, in order for the rules to be exempted, there must be the absence of the desire to avoid UK taxation. And this absence of a desire to avoid UK tax is very, very broad. If you read law, you just cannot get the idea what is this absence of the desire to avoid the UK tax. You must look at the court practice, you must look at all the surrounding circumstances. But we as tax advisors are not comfortable or prepared to give a 100% view if a particular transaction was not done for the purposes of avoiding UK tax. And this creates extra expenses for individuals because in such situations, you must go to UK counsels, tax barristers who know how the mind of the UK tax authorities work and to prepare an opinion. And even then, this opinion is not binding. It is not like a ruling. It's just simply a way to understand your risks and tell you whether it's worth going there or not. And even then, still, the UK tax authorities can start asking questions. What I'm getting at is that I suppose the rules are extremely effective. They are there to stop people from using offshore entities or individuals to park their assets abroad. And this, if this is the effect, then yes, of course, they're doing a great job. And one final point I wanted to make is that there is what we call a European defense. European defense means that if the foreign entity is located in the European Union, then it's much easier to avoid UK tax through the use of the European entity if it has substance, blah, 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 etc. Now that we're not part of the EU, I frankly don't know how long this EU defense will continue and whether the rest of the countries will be like the offshores. So this is a very developing area, and we just must be very much aware of it. I think Ali raised his hand. It looks like he wanted to say something.
Yeah, I just wanted to pass the floor to Ali as well.
Thank you very much, Konstantin and Dimitri. I just want to make some comments also on the CFC questions from a Swiss point of view. Of course, we don't have as such CFC rules in our domestic law, but we have anti-abuse rules. And in order to reply to Dimitri's and José's comments, we still have the effective management issue that is raised by the tax authorities in Switzerland. Of course, and how Dimitri was saying correctly, it depends on the canton's practice, because we have 26 cantons. Each canton may have his need to collect taxes, and if they have a huge need, they will be more aggressive on this aspect and other aspects. And we still have this effective management issue. And also we have this transparency issue of offshore companies. For example, José was mentioning these offshore entities owned, for instance, in that case by a Swiss resident. It was a trend many years ago in the 80s or even 90s, even later for some banks. They were suggesting to their clients to own their bank accounts, Swiss bank accounts, through a BVI or Panamanian or other type of offshore entities, and this has to be disclosed to the Swiss tax authorities since some years now. So we have these two aspects of anti-abuse rules, I would say. And in order to also come back on what Walter was saying about holding company substance, in Switzerland, we have, I would say, a very objective approach where we have two types of substance analysis. Either the holding company has a financial substance, 30% of equity, a maximum 70% of debt, and the other is the physical substance, of course. And if you, it's alternative. So if you fulfill one of the conditions, in principle, you can obtain the confirmation by the tax authorities. And in order to conclude on my comments, I would say in Switzerland, this is the most greatest advantage that we have in Switzerland, is that you can very easily take the phone, call the tax authorities, discuss the factual background with them, and then confirmed by a ruling. And you have to demonstrate that economically it is justified, for instance, for a Swiss tax resident to have his holding company in Luxembourg, for instance. And this is something feasible from a Swiss point of view. Thank you.
Thank you very much, Ali. I think we've commented pretty much on the CFC issue. We have only 5 minutes left, and one major issue to discuss, which can, I mean, we can have, we could have devoted the full discussion only to the common reporting standards, I think, and the practical aspects arising from common reporting standards. But only 5 minutes left, so I think one or two short-term comments on that. And precisely, have there been any tax audits due to the disclosure under CRS rules? If anyone have faced something like that, I would like those to comment. As far as I know, there was some practical cases in Spain or in Switzerland. Jose, what would you say?
Briefly on that, I mean, interesting. We have a special. I mean, we have a stronger CRS. I mean, apart from the exchange of information, the bank accounts, In Spain, we have an obligation of any individual resident in Spain has to file a disclosure of foreign assets in 3 different categories: real estate, bank accounts, and investment assets. Anything above 50,000 euros. This has to be filed yearly, and there's a strong penalty regime under that. Obviously, the save of that is that anyone under the special tax regime does not have to disclose any foreign assets during these 6 years. But under this, I mean, that has been the key point to disclose any foreign assets. And obviously, the counter side of that is that obviously under the special CRS exchange of information, if you do not disclose that voluntarily, the tax authorities might know about that because of the exchange of the bank account information between tax authorities. So that is something that obviously everyone is obviously threatened that has to be fully disclosed in any foreign bank accounts and other assets. So that's the main point in Spain.
Yeah, better be transparent as always. Roy, Dima, anything about UK cases with CRS?
I think I could cover the interesting development happening in the UK. Obviously, when the UK tax authorities receive information under the CRS, under the Common Reporting Standard, they're of course acting on it, but we don't hear much about it because, well, it's just something which is going behind the scenes. However, in the past year and a half, the tax authorities started sending what we call nudge letter. Nudge letter, we kind of push them. In Russian, call it побудительные письма. The purpose of the nudge letter is that you read the letter and the revenue is saying in it, dear taxpayer, according to the information we received, you may have undeclared foreign income. So you have a choice. You can send us a letter saying, no, everything's done. I don't have anything undeclared, and this will be it. Or if you have something undeclared, then please come out clean. I think there are 2 more options, but they're kind of variants of the same. And the way that the reason these letters are sent is that they say, the tax authorities say that they've received some information under the Common Reporting Standard. And there were some debates about whether they have actually received. And the view is they rather have received than they have not received. And the letters, they look very, very threatening. And sometimes if you're a taxpayer, you don't know what to do. And there's no clarity because obviously it is in the interest of the tax authorities to keep the mystery and to keep the risk. But the best advice is not to ignore these letters. You must send them a response. Nothing will happen if you don't send the response, because by law you do not have to send the response. However, it gives them a chance to start an inquiry. The good thing about the UK tax authority, well, the bad thing is that once you are within their point of view, they will go till the end. But on the other hand, they will they'll give you additional time. So advice which I'm giving to clients is don't ignore this. Give them a call, say I need a month, 2 months to talk it over with my tax advisor. I'll be back to you. And this is the best advice that we can give them.
Okay, thank you very much, Dima. I think we are running out of time completely. So I think there was really good discussion, and thank you all very much for your involvement and for the greatest insights and ideas. Thank you very much for participation. I would like to also wish my gratefulness to the organizers of the event, to my co-moderator, Alexander. Thank you very much. I'm sure that we will meet during other panels and discuss major issues in the international taxation and the BEPS impact and all the other things which are happening around. Once again, thank you very much.